Today on InvestTalk, we talked about the impact of Fed rate cuts, answered some questions on stocks like Toyota and Costco, and then finished off the day talking about the inflow of cash into bond funds.
This is InvestTalk. Independent thinking, shared success.
For my main focus point today, I'm hoping to answer this question. How will Fed rate cuts impact stocks, bonds, and cash investments? And more importantly, what are the ripple effects of the Federal Reserve potentially cutting rates later this year? Now, many investors, perhaps like you, are reassessing your strategies, particularly when it comes to treasury bills and other fixed income assets. And firstly, it's important to understand, before we dive in, why the Fed might cut rates. Now, typically, rate cuts are tools used to stimulate an underperforming economy and are not taken lightly. And that's because the implications can vary. During crises like 2008, the global financial meltdown, cuts were deep and fast to stave off economic collapse. Today, the context is decidedly different, more about adjusting to shifts in inflation and moving more towards a neutral rate that will foster economic growth. Historically, markets react positively to the initial rate cut, with the S&P 500 often showing gains in the years following. But each cycle is unique, and that's because the reasons why cuts happen are unique. Rate cuts during a robust economic backdrop without looming threats of recession or heightened threats of a deep recession tend to buoy markets more consistently as compared to cuts introduced amid economic turmoil. If you cut rates because it's time to cut rates, it's different than cutting rates because you're forced to cut rates. Being forced to cut rates means there's underlying issues within the economy. Now, the direct impact for those holding treasury bills or similar instruments is clear. Yields drop as rates drop. So this is where the strategy comes into play. How do you adjust? If you're holding treasury bills for safety and liquidity, they'll still serve that purpose regardless of the lower yields. You'll just get less. It'll just be worth a little bit less. The yield you get, rather, on the treasury bills that are going to be issued are going to be lower. What you're getting, the income you're getting, is going to be less. Now, diversification still remains key here, balancing between cash equivalents for safety, bonds for income, especially if they might appreciate with rate cuts, because rate cuts change already issued bonds prices, and diversifying into stocks for growth adjusts your risk and might cushion against different economic outcomes. Now, remember, the bond market doesn't just wait until the day the Fed cuts rates and then say, "Oh, we're gonna cut yields down." The bond market often anticipates Fed moves. Yields might adjust before the actual cut. They might over-adjust if they're anticipating more of a rate cut. They might under-adjust if they're not anticipating enough. But all this affects bond prices and in turn affects bond returns. So as we discuss rate cuts and their implications, it's kind of crucial to avoid knee-jerk reactions, because it's not about predicting the direction and magnitude of rates. Predicting rate directions precisely is notoriously difficult, even for seasoned economists, traders, portfolio managers. Instead, what we want to focus on, what you can control, your investment goals, your risk tolerance, your time horizon, and how the diversification of your portfolio and the intermingling of the assets within your portfolio get you there. Why you're holding the treasury bills, why you're holding the bonds. And so adjusting your strategy thoughtfully in response to economic indicators and personal finance goals can help you navigate through uncertain times. And always remember, we're not trying to predict the direction. We're not trying to predict the magnitude. What we're trying to do is prepare our portfolio for all possible outcomes. Let's get to the market wrap-up. U.S. stocks were higher today, ending near best levels. The S&P closed above 5,400 for the first time since August 1st. Now up about 5% following that big sell-off on last Monday. The NASDAQ also higher for the fourth straight session, up 6% since last Wednesday. Big tech, along with semis, software, restaurants, Starbucks specifically, we talked about Starbucks yesterday, led the way. Underperformers included energy, HPCs, dollar stores. Speaking of the dollar index was down 50 basis points. Gold finished up 20 basis points, and crude oil, as measured by WTI crude, settled down 2.1% on the back of the rally yesterday of more than 4%. Disinflation, really today's tailwind for the risk sentiment following cooler July PPI print. But other than that, it was kind of quiet overall. Some desks flagging, some pretty thin liquidity, which is to be expected this time of year. People tend to head off on summer vacations and whatnot, and that tends to pick up again in September. Several sell-side economists I saw recently flagged the rising market-implied recession odds and diminished household cash positions and balance sheets being an economic flag that I think we should pay a little bit of attention to. I don't think it's time to run and hide, but certainly something that is developing. Headline July PPI, as I mentioned, up only 10 basis points month over month. The consensus estimate was 20 basis points, so surprising to the downside. Core PPI actually flat against the 20 basis point forecast. This is the softest core print I want to note since March. Release also noting service prices fell month over month for the first time since March of 2023. CPI hits tomorrow, followed by retail sales on Thursday. The street looking for a core CPI to increase 20 basis points, bringing the year-over-year rate to 10 basis points, or bringing the euro rate down 1 basis point to 3.2%. Looking for a headline retail sales increase of 40 basis points in July as well.
Just had a question for you regarding Canadian Imperial Bank of Commerce. Ticker symbol is CM. I'd like to know if you think it's a good stock. I'd like to purchase it, but I'd like to get your opinion. Thank you very much. Bye.
Canadian Imperial Bank of Commerce, ticker CM, is a Canadian financial institution. If you weren't able to discern that for yourself, I think that's pretty straightforward. And it's had a pretty decent year relative to the 52-week. It's up 25%. It's up 9% year to date, 4% over the past 3 months. And a lot of that has to do with some pretty significant growth in its interest income. Its interest income double in 2023 what it was in 2022. Its average annual growth rate over the past 5 years, 20%. And so because of that, its net interest income has grown 5%. Now, with that being said, it's currently trading at $70 per share, which is a little bit expensive in my opinion. It's trading 1.3 times its book value for a financial institution. That's a lot. That's significantly more than I would expect a company like this to trade at. But that's not my problem here. My main problem with this company relative to other Canadian banks that you might be interested in investing in is it has some pretty concentrated exposure. Look right here, geographic segments. Canadian percent of total revenue, 70%. Now, it's made some gains in terms of its revenue share towards the United States, towards other countries, now making up 30% of its revenue share. But for me, with potentially systematic weakness within Canadian real estate, within the Canadian market, that you aren't really seeing as much of in the United States. Certainly the United States is above and beyond in terms of its economic recovery of other countries. This concentration within the Canadian market and its exposure to Canadian real estate and Canadian industry, more so than a lot of these other banks that some people want to get invested in within Canada, is what singles this out to me as a more risky proposition. And certainly because it's trading at $70 a share, near its target price of around 73, according to 16 brokers. I agree with them. This for me it's not a sell, it's not a buy. I would classify it as a hold right now. But either way, I think given its positioning, given where it derives its revenue from, and in spite of some pretty impressive growth, I would have to pass on this name if you're trying to open a new position for now. Thanks for the call.
Thanks, Luke, for taking my call. I was just looking at it. I do not own it. Just wanted to get your take on what you might think if someone wanted to add this to a balanced portfolio.
Yeah, of course. So MPWR, Monolithic Power Systems, I love the name. That's a great name, is an integrated power semiconductor solutions company. So it helps with the architecture for computing and storage, specifically in automotive industrial communication systems. And my inclination is to believe that it probably has run up a lot, as semis have run up as well. And yeah, it looks like over the 52-week period, it's up 72%. It's up 37% year to date. It derives half of its revenue from China. Interesting. 16% for Taiwan, 9.3% from the Republic of Korea. Interesting. So certainly not a lot of its revenue exposure from the United States. Maybe a red flag there. Its sales has grown pretty significantly over the past 5 years. $582 million to $2.1 billion is what they're projected to do in terms of revenue this year. And along the way, their net margins have been stable and upward sloping from 18% to 21% is what they're projected to do this year as well. Let's take a look at their debt. Well, it's a $40 billion company with $8 million in debt. So that's going to be no debt at all whatsoever, pretty much. and they're sitting on $1.1 billion in cash. Everything that I'm seeing, I am liking over the past 2 years. Their cash flow has been improving. They've issued some shares, but not a worrisome level. Their earnings have been consistently doing better. Their earnings have actually been upgraded over the past 3 months, which is good as well. So then the question becomes, what about its relative value? Because it's not just about getting good companies, it's about getting good companies at fair prices. And this is currently trading at 56 times its cash flow. Now, that doesn't mean it can't go higher. But what that means is you're entering at a point where there's a little bit of risk here. There's a probably significant amount of risk here. And they've already reported earnings for this quarter, for this period. They did pretty well. But I imagine that a lot of what happens over the next 3 weeks is going to be tied to how other semis, presumably NVIDIA, does, and what that says about the overall demand dynamics of the market broadly. For me, there are very few companies I would pay 56 times cash flow, even with this type of revenue growth, even with the net margins that are, 31% this year, so up from 18 5 years ago. Even with that kind of growth and the cash flow growth, there is a lot of potential downside. And again, this isn't to say that it is going to go down. It's going to do what it's going to do. But when you look at the fundamentals and you say you're paying a lot, 51 times earnings, 18 times book value, it just seems too expensive to me. Certainly the companies run well because they've been growing consistently, but I just think right now is probably not a good time to enter. It's up 5% today. It has a lot of momentum. It certainly could continue it, but a lot of risk to enter at this point. Thanks for the call. Looks like we have another caller from Pennsylvania. Iraj, you looking at Costco?
Yes, please. Hey, Luke, thank you for what you do. My question is, Costco has been on my watch list for a while. And my recent experience, I was there at like 9:30 a.m. on Saturday. It opens at 10 o'clock. And still the parking lot was full. So people are literally dying to get into Costco, right? So my question is, it appears to be overvalued because I looked at Morningstar, it is 52 times forward PE. So I just wanted to get your take on it.
Yeah, no, it's a complicated one. We own Costco for our clients in one of our strategies, and we have been selling along the way as the prices just continue to march higher. And when you think about a wholesale corporation like Costco, I think we all know what Costco is. And certainly I talk about Costco a lot because rotisserie chickens are a big part of my diet. But Costco's currently trading at 48 times its forward-looking earnings, 31 times its cash flow. And you look at that and you say, this is so incredibly expensive. But it's been here for quite some time. I think we got it for our clients down maybe towards 500 around there, 600. And we've been, like I said, taking profit as it marches upward. And the most recent price spike has been related to the fact that they're increasing their membership for the first time in 7 years. And that's something we were waiting for, something we were looking for. And it retreated back down to close around 800. But even when the market sold off last week, it did well. It did well. Now, looking at relative valuation for a company isn't the same for every company because there are different premiums that are priced into companies. And for me, for Costco, stability of revenue with their membership fees, though their margins aren't even, albeit that great, right? They're 2.6% margin. It's a low margin business. But the stability of revenue on the scale that Costco's been able to do it at makes investors willing to pay higher prices for it, especially in times when there is potential economic stress on the horizon. And so the answer to your question, it's so difficult, and we still hold it for our clients. And it certainly does seem to be that it is at a very high value. It's above its 5-year ranges. And so it's a complicated one. I don't see it as a sell. I don't think it's incredibly overvalued because there are some premia in there that is being priced in. Stability of revenue in times of economic stress. But I probably wouldn't enter a new position right here. That's not to say it's not going to continue marching forward. They've been expanding beyond what their traditional base is. But you are right. It's a little expensive, and this has been a very difficult one for us as well. Thanks for the call. Now let's dip into our InvestTalk YouTube channel question bank. And here's one that came in from user, a bunch of numbers and letters put together. We'll say that. And it's about Edward Jones. It says, what's wrong with Edward Jones? Well, Edward Jones, last time I checked, is not a publicly traded company. Could be wrong here. Not a publicly traded company. So maybe the question is, what's wrong with Edward Jones, the business? And historically, there's been some issues with Edward Jones. There's been some criticism of their business practices in terms of the fees they give, or the high loaded fees they use for mutual funds, high upfront fees rather, on mutual funds that they give to their clients. There's been some legal issues surrounding Edward Jones with some kickbacks for mutual fund recommendations. And there's a lot of ongoing concern as they've shifted their business practice from going towards rather for ultra high net worth individuals and not really tailoring solutions as much to people below that category. And so maybe I'll take this back and say the problem with Edward Jones seems to be the problem with a lot of large shops with vast networks and advisor pools that sometimes, not all the time, but sometimes don't have incentives that align with the incentives of their clients. So when you're looking for advisors, when you're looking for business relationships, one of the most important things is to make sure that the incentives of who you're employing align with the incentives of your portfolio. Because you have to remember that oftentimes a lot of strategies in rising markets will rise and in falling markets will fall. And the thing that really eats away at your return is the cost there. So it's important to see, it's important to know what they're selling you, what they're putting in your portfolio, and how much it costs.
Good day, Justin and Luke. Heard you guys talking and things coming up here for the new year and that. I don't have any health care really at all in my portfolio. I think and hope you guys would agree that that'd be a good thing to add to a portfolio. There's a lot of stocks I'm interested in, but they all seem very overpriced when I hear you talking about them. Eli Lilly, United Health for a couple. So I've looked at a couple ETFs, and I was wondering what your consideration is of those. They are XLV, and the other one I've been looking at is VHT. Do any of these look promising to you? They seem to have a lot of good holdings from what I can tell, and of course they pay dividends. And I don't think the expense ratio is outrageous. What are your thoughts of these? I'm anxious to find out, and would you consider any of these yourselves, or are these kind of thumbs down? Thank you. Look forward to hearing your answers on the show. Have a good day.
Well, first and foremost, if you don't have any healthcare exposure at all, I certainly think it is a good idea to get some. And rather than buying individual stocks, if you don't want to have to check every day, keep up with what's going on within the market and try and get some alpha there, a great way to get exposure to healthcare is through ETFs. And so we got two ETFs here. One is XLV, which is the Healthcare Select Sector Spider Fund, which tracks the healthcare names within the S&P 500 on a weighted market cap basis. And the other one is VHT. And VHT is the Vanguard Healthcare ETF. And what the Vanguard Healthcare ETF is, it takes a wider approach and it looks at the overall US market. I'm not sure what they're tracking here, but it's either going to be the USA IMI, MSCI USA IMI, or the Russell 3000 most likely. And it's going to give a market cap weighted approach to everything within the US market. VHT, 10 basis points. XLV, 9 basis points. The reason why I like VHT more is because it is a broader ETF, which means you're going to get some mid and small cap exposure. VHT is 87% large caps, 7.4% mid caps, 2.7% small caps. Compared to XLV, 98% large caps, little bit of mid caps, 1.8%. Just a tiny bit, but not much. And so historically speaking, small caps and mid caps tend to outperform over the long term. Now, that hasn't necessarily been the case over the past couple of years, and that's primarily driven by a handful of big tech names that have dominated the rest of the market. But even in a fund like VHT, over 80% of it, 89% of it, is in large caps. You're still going to get essentially the same exposure to a lot of those names. It's going to be broader. I think there's 400 and some odd names in there. It's going to be broader exposure, and most of it is still going to be within those large caps, but it's going to allocate in a more broad-based way, give you some of that small cap and mid cap exposure, give you some of the potential higher returns that you get because you're compensated for the additional risk by investing in small and mid cap. So I would go with VHT. Again, very similar exposure. 89% of that portfolio is pretty much the same. And they're doing it for the same price. Thanks for the call. Looks like we're going to go to Jordan in Dana Point, who has a question about ATKR. Do you own it, or are you looking to buy it?
Yeah, looking to buy it. I had it at a strike price, and it's fell below that, and I'm wondering if now is a good time to pick it up.
By any chance, did you leave a YouTube comment question on ATKR?
No, I did not.
Interestingly enough, we were going to answer a question on ATKR today from our YouTube comment section. So we're going to knock out 2 questions with 1. And so ATKR, which is Atkore, manufactures electrical conduit, fillings, cable management systems, infrastructure for safety and security products. And its forward-looking valuations look pretty cheap. But I think a lot of that is probably due to its diminished sales growth over the past couple of years. And so, when you look at it in terms of its price relative to its forward-looking earnings, yeah, it's 7 times or 7.9 times. It's 8 times. But that doesn't tell you based upon, it doesn't take into consideration what its earning growth looks like moving forward. And so there's been a lot of selling recently, right? It's down 40% year to date now, down 40% over the 3-month, 36% over the past 52 weeks. And so you may say to yourself, okay, maybe I do want to catch this here. But regardless, taking a look at its chart, let me wait for this to pull up here. Gotta love the internet. But anyway, so when you take a look at a company, even though it's had a precipitous sell-off over the past couple weeks, you have to ask yourself why. And to me, even though it looks like it's an appealing price point based on its forward-looking earnings outlook, I'm looking beyond that into the medium and long term, and I'm seeing that its growth has fallen off. And so even if you wanted to buy it now, it certainly hasn't found any new support since this sell-off. I certainly would not buy it now. If you want to keep it on your watch list, that's fine. But I think the broader problem here is that growth picture. And until they are able to address that growth picture, I don't think the market is going to really provide any support near where it is right now. Thanks for the call. Looks like we got another call from Peter in Rhode Island who has a question about TM. Do you own it, or are you looking to buy it?
Hi, Luke. I'm actually looking to buy it. I think with Toyota having the hybrid game ahead of most instead of the strict EVs and the potential rate cuts coming next month, I think it's down quite a bit. I was wondering if this might be a good time to get in.
Yeah, so Toyota, I think we all know what Toyota is. I think they have some pretty excellent cars. I never heard of anybody whose car died while they were driving when it's a Toyota. I think my parents had Toyotas growing up as well, and they're fantastic vehicles. But I think you probably would guess that what I'm going to say is this is a car company, and the natural state of a car company is dead. They have $241 billion in debt on a $226 billion market cap company. Now, most of that's pushed out pretty far, and so their interest coverage ratio is 51 times. That's certainly a good sign. Now, I also want to push back a little bit on the whole, with interest rates being cut, this, and that. The market is pricing in that rates are going to be cut 25 to 50 basis points. It was the last time I checked around 50-50 on what it was going to be. But because the market is pricing there's going to be interest rate cuts, the market is also taking into consideration, this omniscient market, is taking into consideration how that's going to affect companies like Toyota's debt financing, expansion, all sorts of things. And so even though they've got a good hold on the EV market and they pared back from, or rather on the hybrid market, and they pared back from a lot of the investments in EV or electric vehicles like a lot of car companies have. About 3 years ago, pretty much every car company was talking about how they were going to be exclusively electric. That's certainly not the case now, which is a good thing for a lot of companies and for specifically Toyota. I just think they have some growth issues that they haven't pushed past. Their growth over the past 5 years is about 2.7%. If you think that consumers are paring back on spending because you have a contracting labor market and consumer spending is going to fall, and cars honestly last a lot longer than they used to, right? I've always said that there haven't really been a lot of advancements in car technology since CarPlay, right? When I'm looking for a car to buy, when I looked for a car to buy last time, I just needed power steering, power windows, air conditioning, and CarPlay. Since about 2017, there haven't been very many advancements. Certainly there have been in terms of fuel efficiency, which is going to be important, but you don't need to buy cars as frequently as you used to. So when I look at a company like this that has a lot of debt, that is in an industry that historically does not do well, I just think there are other places where you can put your money. That being said, Toyota is certainly one of the better ones. Still a car company. Thanks for the call. Now let's shift gears and dive into really the market turmoil that we had last week. And that's because there was a surprising period of volatility after a long period of calm. And so let's break down what happened, what's happening, and what it might mean for investors. Now, after about 18 months of relative quiet, the stock market entered, and maybe is entering, a phase of heightened volatility. Just last week, the S&P 500 experienced its best and its worst days since 2022. Now, this shift comes as traders adjust their strategies, moving away from investments that thrived in stable conditions and reduced bets on continued market flatness, while also unwinding a lot of leverage. So what's driving this new anxiety? Well, several factors are at play. For one, there's growing skepticism about the benefits of artificial intelligence. There's been a lot of CapEx for a lot of companies with not much to show for it. And so this has prompted a potential massive shift, reallocation away from some of these tech names and towards more value-oriented strategies. There's been a concern about the weakening U.S. labor market that has stirred a lot of economic fears. There's been anticipations of the Federal Reserve cutting interest rates in September, which could significantly alter global flows, and uncertainty about what the level of cuts will be. There was also an unexpected hike in Japan that caused an unexpected unwind of mass amounts of leverage through the carry trade. And then add on some increased tensions in the Middle East. And so looking ahead this week alone, we're bracing for more potential market movers. Certainly, there was good news today. PPI came in cooler than expected. There is an upcoming inflation report tomorrow that could additionally set the tone for the next Federal Reserve meeting, as well as PCE at the end of the month. Retail sales data might further influence expectations, might hint towards what is happening with the consumer. And so for those managing portfolios, and I don't just mean myself, but I mean you, these conditions suggest a time of caution, but also opportunity. Volatility means heightened price movements. There's additional risk. But it can also present chances to buy at lower prices if you're focused on longer-term gains. Now, investors might consider whether to adjust their risk exposure, particularly in tech stocks. It seems like the market is doing a significant amount of that, specifically with hedge funds. And so that's really been at the heart of a lot of the recent fluctuations. But while the current market dynamics might seem daunting, they offer a clear reminder of the importance of staying informed, ready to adapt, and as we've seen, conditions can change very, very quickly. So the most important thing is, like I said with respect to rate cuts, not to guess the degree and magnitude, but be prepared for all scenarios. Now let's keep things moving and head back to the InvestTalk voice bank.
This is Matan calling from Tel Aviv. We enjoy your show here very much. I'm calling today because I want to increase my portfolio exposure to the industrial sector. I got a small position in ATKR, and I'm looking to get into Caterpillar, ticker symbol CAT. I would love to know what your thoughts are today, what would be a good entry point, even for a half position, and your thoughts on holding Caterpillar for a long-term hold. Thank you very much. I'll listen to your answer every morning here on the show. Thank you, guys.
Well, thanks for being a consistent listener. We certainly appreciate that. So let's try and tackle your question here. It's about Caterpillar. Now, first and foremost, I think it's good that you're trying to get industrial exposure, especially in a time where we've seen, the hints of a broader market rotation. And Caterpillar is a great company. Historically, it's paid a dividend for over 90 years. 90 years, consistently. Over the past 5 years, management has repurchased about 11% of its shares. It's doing things that typically we like. Over the past 3 years, cash flow has been improving. Profitability has been stable, if not improving. Its net margins are up from 7% in 2020 to 15% last year, projected to be 16% this year. Its revenue is growing pretty consistently at 4%. Now, in the past 3 years, that's even heightened even more. $50 billion in revenue in 2021, projected to be $65 billion this year. Great growth, great cash flow growth, good margin improvement. But with that being said, it's a little expensive. It's trading at price to book about 9.5 times, price to cash flow of 12 times. For an industrial company, that's pretty expensive. And so the question becomes, where would I think is a good entry point? And hopefully the chart picks up a little bit faster than it did last time when we were looking at Atkore. Unfortunately, it's not. So what I will say is if it's trading at about a 9 times price to book, if it's trading about a 14 times price to cash flow, I would wait for that price to cash flow to come below 10. I would wait for that price to book to come below 7. I think those are more reasonable valuations for industrial companies. And even though this company is certainly doing very well, cash flow is improving. Again, we like that they've been consistently buying back shares. It is one of those companies where you say, okay, dividends aren't always guaranteed, but 90 years of paying dividends is nearly a guarantee. Great company, definitely get more industrial exposure. I would wait for that price to cash flow to come down below 10. I would wait for the price to book to come closer to the realm of 6.5, 7. Let's play 2 in a row.
And this is Randy from Tampa, Florida. I wanted to ask if you guys had any recommendations on good applied materials stocks. I'm looking at AMAT. Would love to get your opinion on that stock. Thank you so much.
Applied material stocks. Well, AMAT is, guess what? Applied Materials Inc. Provides manufacturing equipment, service, and software to the semiconductor space. Its cash flow has been improving. Its profitability looks great. It's got a bit of debt, about $6 billion on a $159 billion market cap company, so not too much. It's sitting on a lot of cash, about $6 billion of cash. And its earnings have been consistently upgraded. Now, with that being said, its valuation is incredibly high, I would say. Its forward-looking price to earnings is somewhere around 21 times. Price to book, sitting at about 10 times, it looks like. Either way, this is certainly a well-run company, but given its move in valuation over the past 8 months, 9 months, I would wait for it to come a little bit back down to earth. Thanks for the call.
Hi, this is Gable Garza. I'm calling from Central California, Hanford to be exact. Calling in about a stock, NXPI, the semiconductor. Trying to get in the space, and I know Justin was saying that it's very cyclical, but I believe these fundamentals are good, and I want to know what's a good entry point, and is this a good time to get in? Can't wait to hear your answer, and appreciate everything that you guys do for us. Thank you.
So NXPI Semiconductors is a semiconductor manufacturing company. And I think they primarily are focused on automotive and industrial uses and communication infrastructure as well. So not semiconductors, think artificial intelligence. Semiconductors, think chips within car computers. In fact, 55% of its revenue comes from automotive. And this is an impressive company. I'm not going to lie. It has reduced a lot of its costs because it's done what I mentioned Intel has been trying to do yesterday, which is create this foundry model of internal production capacity. And they've done it very well. Look at their gross margins from 36% in 2018 to 53% in 2020, 54% last year. Their net margin grew from 2.7% in 2019 to 21% this year. And another thing they've done is they've also passed a lot of cost savings along to consumers. And so now they're more price competitive as well. It's trading at a reasonable price. Price to book about 6 times, where its average is slightly above its average. Its price to earnings is slightly above its average too, 16 times. Price to cash flow, about its average, 16.7 relative to 15.5. But the problem for me is that 33% of its revenue comes from China. And that's not because I don't like China. That's because the reality is that demand is going to be dampened in China probably over the next 6 months to a year. And so this is a great company, and I would keep it on my list. But the question was, is now a good time to get into it? And I think the demand dynamics coming out of Asia, where a lot of its revenue comes from, would lead me to believe that now is not the right time to invest in, again, a great company that has significantly reduced its cost and create a foundry model that most semiconductor companies can only dream of. Thanks for the call. Now, before we head off, I want to talk about a little bit of a shift in the bond space. In the face of last week's equity market rout, U.S. Treasuries and other highly rated debts have staged a pretty notable rally, drawing yields to their lowest levels in over a year. Now, while some of these sharp movements have since reversed, the message is pretty clear. Bonds are back. Now, this rally underscores the bonds' appeal in times when growth is slowing, inflation is easing, and central banks, including the Federal Reserve, are expected to cut interest rates. Investors have poured substantial amounts into U.S. government and corporate bond funds, with $8.9 billion in August alone, following a massive $57.4 billion worth of inflows in July. In fact, this marks one of the largest influxes of cash since mid-2021. High-grade corporate debt in particular has enjoyed 10 weeks of positive flows, the longest streak in 4 years, indicating a strong resurgence in interest towards fixed income assets. Interest in fixed income? Unintentional. So why bonds and why now? Well, the landscape shifted dramatically following a weaker than expected U.S. jobs report earlier this month. The jobless rate nudged up and job additions fell short, leading traders to anticipate aggressive rate cuts by the Fed. More than 1 percentage point by year end, in fact. Now, the expectations have certainly pared back a little bit. Maybe a lot of what was associated with the rise in interest rate was due to natural disasters that had temporary layoffs. That's certainly true. But the expectation has been made that bonds, particularly treasuries and high-grade corporate debt, is attractive. Even in sectors typically considered riskier like corporate debt, movements have been relatively stable compared to the equity markets. High-yield junk bonds, for example, experienced only a minor loss in the face of that global sell-off. And so that suggests that even though the economy may be slowing, credit markets are holding up rather well. And so as we await further economic indicators, including the upcoming inflation data tomorrow, retail sales on Thursday, and more data later in the month, the bond market's reaction could dictate a lot of what the Fed decides to do and should dictate what you decide to do as well. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. Please be sure to rate and review us on iTunes. Also, if you're interested, head over to our InvestTalk YouTube channel. That's InvestTalk with 2 T's, where you can check out our audio podcast in video form. Independent thinking, shared success. This is InvestTalk. Good night.